Okay, I'm gonna first drop the file in here again. Okay, class number 16. All right. Welcome everyone to class number 16. Um, Today class, I believe we're gonna wrap up with the loan activities, MLO activities, and then we're gonna go with ethics starting next week. And then if it's happened that that we may need to take one or two additional day for wrapping up the material because um each day each topic may require 3 days and we still have two more topics, one topic for ethics and one topic for um for the California license. Okay, so I may take them to the next week as well, the week after, and then after that I'm going to open up with the training for taking the exam because I know there are a couple people on here already finished the class, get ready to do some practice tests, get some feeling on what's the good strategy to take a test. Okay. So anyway, welcome to the 16th class, and today we're gonna continue with the MLO activities, loan qualification, processing, and underwriting. Okay, let me see here. I think this is a slide that I borrowed from the previous class. Okay. Let's see. Okay. So, like I said, the settlement closing agent um, in California, when you open an escrow, you get an offer accepted, you open an escrow, then there is an escrow officer that gonna help with facilitating the transaction, for the whole, purchase, including all the paperwork, get the EMD in, get all the loan docket ready, inspection, title change, and other, document signature and notary and stuff. Okay. So on the different state, like maybe Texas, Florida, um, Arizona, they may have an attorney at the office during the closing day. Okay, so some state that they require like all the parties joining together on that same day to sign the document, to sign the transfer, to disperse the money and all that. Okay, everything happened on that particular day. Okay, so meaning that, hey, they have to, the buyer have to be there, the seller has to be there, attorney has to be there, agent probably gonna has to be there, loan officer, title company, and everybody got to be there, right? It's a little bit cumbersome to me, what I'm thinking for for those states, okay, and that is just the way that they do business. Okay, for California, literally on the day of closing, we don't even need to be anywhere. We just stay home, wait for the funder, wait for the lender to fund the money. Once the money fund, title recorded, title send an email to the buyer agent or the selling agent, right? Um, take a note of this. When I'm saying buyer agent and selling agent is the same agent, which is the agent helping the buyer. When I'm talking the seller agent or the listing agent means the agent that lists the house. Selling agent is the agent that go to sell that house by looking for a buyer to buy it. Okay, so when you hear the selling agent and the buyer agent, is the same thing. When you hear the listing agent and the seller agent, is the same thing. Okay, so at the closing, borrower seller ability to review the HUD or the HUD closing disclosure or the CD. Okay, and gotta be double checking the loan amount, the loan type, term, interest rate, monthly payment, some key details, such as whether you are paying point or not, receiving closing costs or no, closing cost credit or not. Okay, make sure you compare the APR on the closing disclosure with the APR on the loan estimate. Make sure they don't, that much different. Okay, because there's some tolerance allowable too, right? This can be shown whether your costs have increased or decreased. If it's increased, it's a bad thing. If it's decreased, it's the good thing. Okay, for example, right, during the purchase, the loan estimates say that you may have to pay $695 for appraisal. However, the closing disclosure does not include that in there, probably because the lender, get more information about the property, and they say, okay, we don't need an appraisal for this property. So that's why that thing is that removed from the from the closing disclosure. So which means that sometime when disclose the loan estimate, uh, loan officers, right, sometimes what they do is called over disclosure. So meaning that they rather add all the fees up front, and if anything that cannot be taken out, they will move forward with that fee, right? Meaning they over disclosure, right? They over, let's say overpay, at first. So meaning that they will try their best to take out those fees if they could, right? If they cannot, then those fees are going to carry on to the closing disclosure. If they could, then they're going to lower down the total cost total closing cost that the buyer has to pay. Okay, and like I say, ask a lot of questions. Hiring a real estate attorney to review the documents, but it's optional. Eligible signature on the security instrument must be 18 years of age, must have the ability and capacity to sign. Okay, only the borrowers to sign the loan document. Um, Even if there are like several people on the title, but only the one that that borrow the money going to sign majority of the documents. But some of the document may also need some consent from all the people on the title. Let's say that you agree that this person on the title is also on the loan. It's just more or less like an acknowledgement, okay, for the one that's not on the loan to know and say, hey, if for some reason this home got default, right? You also know, and you also agree that this person on the loan, but the loan is not getting paid. So we, as a lender, coming in and foreclose your home, even if you are still on the title. So that is some kind of consent, some kind of agreement that that all the people on the title need to know. Okay, and that's also cover the track for the lender. Eligible, let's say, continue only the borrower to sign the loan document. Co-owner also need to sign title and related documents. Okay. Use of the power of attorney. Using the POA to sign a document for other person who signed the power to sign, for that person. So I am currently have a case that the buyer is happen. I'm actually buying and selling a property right now, and the seller is actually currently in Vietnam. Okay, so meaning there's several ways that as a loan officer I can do, or as a real agent I need to do, is that okay, if this person is in Vietnam, but this house need to be sold, and the seller agreed to sell it, but cannot present here at the moment. But one thing that we can do is that we can ask the seller to do the POA, power of attorney, assign that to somebody else to perform this task. Right? Hey, I give this Mr. John Doe the permission as a power attorney to sign all the paperwork necessary to sell this property. That something can be done. Okay. Or if that seller is still in Vietnam, that seller can also still helping out with the to facilitate the selling as well. By any document that need to be e-signature, that seller can sign online too. No issue at all. But anything that need to be inked, that seller need to go to the embassy in Vietnam and working with a notary person at the embassy to sign any document that's required, right? And then that document eventually going to send back to the US, okay, maybe 5 to 7 days, 5 to 7 business days, okay? And then we have the link, and everything else gonna be just e-signature. And one of the last document that seller need to sign is the deed of trust, title transfer, right? Those need to be notarized, and that can be done at the embassy in Vietnam as well. Okay, so nothing is impossible. Everything is workable, and that means that as an MLO, you need to take into account of those additional time, right? The travel time, the time to call the embassy and set up a signature, right? And the time that document, that physical document, need to get back to the U.S. So all that need to play, into account. Uh, and working with the realtor, working with MLO, working with the escrow officer, everybody need to understand the situation. So if you know something, say something. Okay, if you know that, hey, I know that this seller is not here, he may be on travel to France, right? Then now we have to find a way. If we want to facilitate this transaction, then we need to find a way to resolve that issue. Okay. Explanation of fees. Fees or charges listed under CD. I should say HUD1 or CD, right? Nowadays we're using CD, but the HUD is something that we used in the past. But in some cases, we're still using HUD. Okay, but just using everything as a closing disclosure, should be okay. So this closing disclosure settlement statement review and make sure all charges and terms are correct, right? Title insurance fees, the borrower will pay for the lender title insurance. Okay, the seller will pay for the borrower title insurance. Some prepaid fees, including appraisal, paid by the if there's an appraisal, paid by the borrower. Inspection, paid by the buyer. Credit check, paid by the borrower, right? When I say borrower and buyer, it's pretty much the same thing, okay? Because borrower is for loan, buyer is for the real estate. Repairs, any repairs could be paid or get credit back from the seller. Okay, some estimated and quotes. Okay, quote for repair, hit this, quote for repair that, quote for fixing, foundation, quote for fixing the roof, whatever, right? These are some of the prepaid fee. Some of the thing that we can be done is that if there's a repair required, like fumigation, right? Termite, right? All those work can be done by a contractor, but the seller doesn't need to pay upfront and can pay those contractors at the close of escrow on the day of, or when this got disbursement distributed of the checks, right? And any repair quotes or thing like that, or scope of work, invoice, right? Any of that can be dispersed by the loan officer, paid to all those contractors at the end. Sometimes that they have a company say that we're gonna renovate your house and we get paid up, right when you sold your house, right? That's how it works, right? The seller may not have the money to renovate, but want to sell it at a good price, and they don't have the money, right? But once they sell the home, they will have money to pay back, right? And the contractor want a business, and they make that happen. Say, okay, if you use our business, we don't collect the money now. We collect once you sell your house. But guess what? If you don't pay, if you don't sell your house and you don't pay, we put a mechanical lien on your property. That means you cannot sell the house no more until you pay off that. Okay, so that's how everything works nowadays. Loan origination fees. Right, earlier I just talked with Trung that regarding to the fee that we're gonna charge the borrower. Right, a loan origination fee is a charge as a percentage of the loan amount, usually anywhere between 0.5 and 1%. But sometimes it can go up to 2% too. It's a usually, but it's flexible. Okay, of the loan amount plus any mortgage point associated with your interest rate. Okay, the loan origination fee is that we, as the loan officer, we want to charge 1%, 1.5%, 2%. That is, we allow the borrower to pay. So that's why we have the flexibility of charging that fee, and that fee is our commission. Okay, so if we let the broker pay, if we choose the broker pay instead of the borrower pay, then whatever the broker set with the lender, and that's how much the lender gonna pay us. Okay, pay through the broker, right? However, if we choose the broker pay, the rate gonna be higher. Okay, and let's say every that's a commission for us, but there's an additional income for us as well. Okay, meaning if we pick the 6.75, right? We get like we get like $4,000 credit, but if we get 6.5, we get 0 credit. Okay, so meaning the higher the rate, right, there may be some credit back, or the lower the rate, we may the borrower may need to pay some point. Okay, so meaning that if the borrower get a higher rate, then there's some credit back. Guess what? You have the ability to give some to the borrower, or you can keep that credit, right? So if you charge a 4,000 origination fee, and there is another 4,000 for credit, right? Sometimes if you look at the situation and you say, okay, I think I can keep everything, then you keep 8,000 total. Okay, but if you think that, hey, this person I know, if I don't give him something, he may go to somebody else, then you're gonna give something, 1,000, 2,000, 3,000, 4,000, however you want to give to that person. So meaning that if you do that, you pretty much transfer all the credit to the borrower. That help paying down some of the closing costs. You keep the business, you get some commission already, right? And maybe that person gonna refer your business to somebody else, right? Or come back with you again when that person wanna buy more houses or do more refinances, right? So that is just how you're gonna play your game and collect your commission accordingly, and also keep the recurring residual businesses that come back. Okay, so that's a really good thing. And you have to make that decision now too. Okay. So some explanation of the document. All right. The required document at closing, including the CD, closing disclosure, loan estimate is actually at the beginning, proof of homeowner. If you do a refinancing, right, you need to know that you need to make sure that you are the owner of the property. You cannot refinance somebody else's property, right? Actually, I'm sorry. They say proof of homeowner insurance. I forgot to the next slide. Okay, so in this case, if you purchase a home, right, then or even refinance a home, you still have to show that there is a home insurance cover for this property, so that the lender will say, okay, you have the home insurance. That's good. I'll lend you. So if you burn out a house, I still have cover the money from the insurance company. So the lender happy with that. Loan application is a must, something that must be done, for the process of lending. Mortgage note, which is the promissory note. When you see a mortgage note or when you see a promissory note, it's actually a term. Okay, that's saying, okay, Mr. A borrowed from the lender B, paying 3,400 a month with the rate of 6.5 for 30 years, right? The beneficiary is the bank ABC, right? So that's meaning that if the borrower don't pay, the bank has the right to foreclosure the home. Okay, deed and title. Okay, deed is that because it's a promissory note, right? The deed is say, okay, if I don't pay, the beneficiary is Mr. ABC or Bank ABC. Title meaning that seller A is selling the home to the buyer B and transfer that title from seller A to the buyer B, so that the buyer B now is the owner of the property. Okay. Required document when using a property as a collateral, right? Security agreement, guarantee or collateral agreement, pledge agreement, deposit account control agreement, security account control agreement, mortgage. So these are some of the ways of using the property as a collateral, right, to borrow some money elsewhere. Okay, so these are some typical way of getting money or borrowing a loan or whatever. Okay. Note disclosure CD on a loan. A closing disclosure is a 5-page form that provides final details about mortgage loan you have selected. It includes the loan term, your projected monthly payments, and how much you will pay in fees and other costs to get the mortgage closing costs. Okay, so that's on the CD. The CD have 5 pages. Okay, and it's listed like individual section for individual category. Assumption clauses. Okay, assumption meaning that the borrower say I want to borrow the money to buy the home, and I assume this loan. Assumption meaning that okay, now everything is all set. Now I already assume the loan, so the loan is under my responsibility to pay back. Okay, assumption clause is a provision in a mortgage contract. Mortgage contract, not the real estate contract. Okay, in a mortgage contract that allows the seller of a home to pass responsibility to the existing mortgage to the buyer of the property. So in other words, the new homeowner assumed the existing mortgage and along with ownership of the property that secured the loan. So that's an example to this, right? I think my early explanation may be a little bit off track. Okay, when we take the loan, when the borrower buy a new home, take on the loan, that's consummation, right? Take on the loan. The assumption here means that the seller, right? Let's say the seller have a VA loan or an FHA loan, okay? And with VA and FHA, they have a program or they have a way say that, hey, you can pass this loan to the new buyer. Okay, the new buyer can assume your loan. Okay, meaning that if you still owe $300,000 and your rate currently at 2.7%, right? You can pass that to the new buyer, and the new buyer have to come in with the difference. So meaning that okay, let's say if this home is 400,000, but there's still an outstanding loan of 300,000, the new buyer gonna assume that loan 300,000 from the lender of the current property, right? And the transaction is that selling the home for 400, so there's a 100,000 different. So the borrower have to come in with 100,000 different, and then assume that loan and continue to do so. Sometimes you can work with that lender, that same lender that allow the assumption of the loan, and that you can ask the lender, hey, what about you finance me the second mortgage? Okay, meaning that I may need like a 50,000 because I only have 50,000. I don't have 100,000. I only have 50,000. Why don't you give me the second lien? Okay, since I already assumed this loan, right? You just check my credit and make sure that I have ability to borrow the second lien for $50,000. I put down payment $50,000, right? So that way that the buyer can assume the loan of the seller and then maybe borrow the second lien, right? And then take on the take on the property with 2 loans. There's assumable loan as well as the second lien. Okay, things like that can happen. Okay, providing the escrow analysis statement. Escrow account analysis means the accounting that a servicer conduct in a form of a trial running balance for an escrow account for. So let's say if any purchase of a home and there is an escrow account, then there's some disclosure of the the report, the accounting, the analysis of that particular escrow account to the borrower, almost like every year. That accounting determine the appropriate target balances. Okay, what is the minimum balance that the money need to be stay in the escrow account to help pay for mortgage, to help pay for insurance, to help pay for PMI and so on. Okay, compute the borrower monthly payment for the next escrow account computation year and any deposit needed to establish to maintain the account. So like every year they do this analysis and say, okay, for next year, maybe your account need to have 6,000 in it, okay, or a sixth of the total of the year, right? So when that happens, is that they give you the analysis. Or maybe this year, the next year going to be the same as this year. Oh no, maybe next year going to be a little bit lower than this year, or maybe next year is a little bit higher than this year. When the case that you get rid of the PMI, then obviously the next year escrow balance going to be dropped. So this report going to tell this report gonna tell the borrower, say, hey, your escrow target balance for next year's drop, right? This is the amount, right? Maybe the reason is that because you already pay off the PMI, right? Or it's maybe increase because home insurance is increasing, right? Something like that. We'll need some kind of report and analysis to provide to the borrower for that particular escrow account. Thirdly, determine whether the shortages or surplus or deficiency. Okay, if there's a shortage, then the borrower need to put more money in. If there's a surplus, meaning extra, then the servicer will credit back, will pay back that money to the borrower. If there any deficiency, then the servicer will work with the borrower to correct that. Okay. A servicer shall submit an annual escrow account statement to the borrower within 30 calendar days of end of escrow account computation year. So meaning that after 11 months, step into the 12th month of the year, the servicer need to provide the annual escrow account statement, right, to the borrower within that last 30 days of the year. Okay, then that escrow account statement telling, okay, for throughout this year, you pay this much for how much is for the mortgage, how much for the interest, how much for the principal, how much for the insurance, how much for the property tax, if any PMI. Okay, so that statement is kind of include all that kind of thing. Okay, funding. Okay, funding. When does a rescission period end? Okay, rescission period meaning that when can a borrower change of heart happen so that they don't need to move forward with the loan or cancel the loan. Okay, and when is the deadline to cancel for the refinance? So like I say, rescission period is only happen with refinances. It doesn't happen with the purchase, meaning that the borrower who borrowed the money for purchasing doesn't have the right for rescission once the loan is funded, okay, or like within the closing day. Okay, with the refinance, right? Everybody agree, okay? Everybody signed the loan doc, right? But the borrower still have a right of rescission ends at the midnight of the third business day. So let's say if this borrower signed the the loan document for a refinance on Monday, okay, and then the bank not going to fund the money right away. Even the document is already signed, notarized, and everything. But the lender won't fund until the end of the third business day. Because what? What happened if the lender fund and the borrower have a change of heart? Because the borrower have the right to rescission due to one of the law. I forgot which one that was. Okay, so the law allowed the borrower to change, okay, and say, okay, I have a change of heart, I change my mind, I cannot bear this, I want to cancel the refinance. So within the 3 business days, if the borrower make that decision, then everything roll back. Everybody waste all the time, right? The borrower probably waste the appraisal fee, maybe a credit check fee, right? And obviously, because the lender won't fund prior to the midnight of the third business day, because what happened if the lender fund, the money get into the escrow, then the money gonna sit there and wait for 3 days, okay? Or if the borrower decide not move forward with the refinance, then that money gonna have to travel back to the lender bank account, and it caused a lot of hassle, right? That's something the lender doesn't want to do. So they're gonna wait until the third business day end, and they fund the money. And that way, everybody moving forward. Funding regarding rescission period. Funding is not distributed after the rescission period has ended. So that I just mentioned. Okay, payments. How we going to calculate the payment? Okay, interest rate calculation scenario. So in this case, I'm going to walk through a couple of examples here to see how we're going to calculate the payment. Okay, the first one is a calculation scenario for mortgage insurance, a PMI. Okay, take the PMI percentage your lender provided and multiply it by the total loan amount. If you don't know your PMI percentage, calculate for the high and the low end of the standard range. Use 0.22% to figure out the low end and use 2.25 to calculate the high end. Okay. The result is your annual premium. To estimate your monthly premium divided by 12. Okay, because the PMI is calculated by year, right? The percentage here is per year. So if you want to calculate how much you're going to pay per month, just take that total divided by 12. And that's the number of the payment per month. Calculation scenario for the interest rate. How to calculate interest rate, right? Total simple interest formula. The simple interest formula for calculating total interest pay in the loan is the principal multiplied by the interest rate multiplied by the number of years. So the total interest due on loan is calculation. Let me see here. Calculating the total interest pay for the loan. Okay, so this is the way of calculating just for the interest. Okay, is that get the principal multiplied by the interest rate, multiplied by the number of years that the total interest due on the loan. Okay, but that is mainly for any particular loan, not the mortgage loan. Okay, the mortgage loan has a different calculation. Okay, so here we have a calculation scenario for loan amounts. Let's say if the purchase price is 500,000, and if we say the loan amount or loan to value, the value is 500, the loan to value 80%. So how much is that for the loan that we're going to borrow or the borrower are going to take from the bank? Okay, the loan amount equals 500,000 multiplied by 80% loan to value, okay, which is 0.80. So the loan amount total is 400,000. So meaning the borrower going to borrow 400,000 from the bank to buy the home and down 20%. Okay, that's pretty simple math that we can do there, right? So another example, right? If you take out a $200,000 mortgage at a 4% interest term, the calculation looks something like this. 200 multiplied by 0.4 equals 8,000. Okay? That is the interest. That total interest you pay over the life of the loan. Okay? The daily simple interest formula calculation is the open balance multiplied by the interest rate divided by 365 time number of days. Okay? The day for payments equal the interest due for the month. So for example, right? Let's say if you close a loan on the 16th day of the month, okay, that meaning that you still have 14 days left of the month that you need to pay interest on. And the way to do that is that you need to find how much per day that you're gonna, the interest gonna be. And then you multiply that how much per day with the remaining number of days per month. If this is a case for 14 days, then you take that 14 day multiplied by the dollar amount interest per day. And then you get the remaining, and you include that in the payment during the escrow, right? So in this example here, the daily simple interest formula calculation, you have an opening balance or the total loan amount. Okay, let's say if it's a 400,000, okay, that's going to be opening balance. you multiply the interest rate, divide by 365. If the interest rate is 5%, right? You multiply with that, and then you divide by 365. That is for 1 day interest charge. And then you multiply the remaining number of days, okay? Then that is how much you're gonna pay for this remaining month, right? So in this case, if a $200,000 rate of 4% or 0.4, and you divide that by 365, you times for 30 days payment, meaning that this is starting at the beginning of the month. Then the total interest that you're going to pay is $21.90 for the whole month, for that 30 days. Okay, calculation scenario for monthly payment, multiply that number by 30, and you get by 365, no, $657. Okay. Effects of escrow mortgage. You will pay more having your mortgage lender servicer hold your property homeowner insurance payment and everything. So meaning that the escrow account gonna require you to pay more, right? Because you let the servicer to handle all the payment, like mortgage, property tax, interest, property tax, insurance, and PMI, right? So meaning that you have to pay more each month. Otherwise, if you don't have that escrow account, then you just pay for mortgage. And then when times come for paying the property tax, or when time comes paying for the insurance, you can take money from your savings, your checking, or even your credit card, right, to pay for that. Okay, so that means that your monthly payment is less if you do that. Oh, I didn't realize that I am still zooming out. Okay, sorry about that. Okay, periodic interest. What is it? Here's some financial calculation used for mortgage lending. Okay, the periodic interest is interest rate calculation scenario. So there are 3 different interest calculation: a fixed, flat. A fixed flat calculation method is the only method for which interest is not accrued over time. Okay, meaning increase over time or combine over time. So let's say if the loan amount is let me see here. If the loan amount is 1,200, the rate is 5%. So your total interest payment is $60 a year, right? So you have a loan amount 1,200. The rate is 5%. You multiply that, right? Multiply 1,200 with the 0.05. You got $60 a year. That's how much interest you pay per year. And then if you want to calculate for per month, you take that, you divide by 12, right? To pay like per month. Paying back $100 per month for 12 months. Okay. So let's say if a loan for 1,200, you're gonna pay back $100 per month. That's gonna take about 12 months to pay it off, right? But the interest payment is $5. So monthly payment is actually 100 plus $5. Right? This is a fixed flat calculation. Okay, so that's how you pay back $100 plus $5 interest. Your monthly total is a 105. Okay, declining balance. The declining balance method reflects the actual cost of the loan more accurately than the fixed flat method, as the interest is calculated on the outstanding balance. The client only pay interest on the actual amount they still owe and not the total amount. So let's say if Mr. John Doe borrow 1,200 from a credit card, okay, with an interest rate of 5%, right? And if Mr. John Doe pay $100 for month number 1, so meaning for the next month, the calculation for the interest pay is only for 1,100, but not 1,200. Okay, because Mr. John Doe is paying down the balance. So the next interest rate gonna just only charge on the remaining balance, but not the original loan amount. Okay, if you pay principal down, you only pay what is left that owe to the bank. Okay, declining balance, equal installments. Okay, so now that's how that's how the regular credit card is charged, right? You pay you pay more to the principal, right, and including the interest. Then next month you're gonna pay less, and pay less. Okay, but that's a way of paying an equal installment. So meaning that each month that you pay, you're gonna pay the same amount until you pay off all the principal, including the interest. Okay, so it's called declining balance with the equal installment. It's similar to the declining balance method in that the interest is calculated on the outstanding principal amount. However, the difference is the client pay equal installment for the duration of the loan. This is achieved by increasing the amount of principal being repaid as the interest decrease, adding up to the same fixed amount for each installment. So what happened in this scenario is that, okay, if you have like a loan for 1,200, right? You calculate the interest in total, that's $60 per year, right? And then you say that you pay $5, but you can pay 105 every single month, right? And no, actually, it because like every month you pay, the principal will get lower, right? So the equation, if you want to pay the same amount, right, then each month the principal gonna decrease, right? And also let me see here, and the interest rate is also discrete per per that too. And then after you calculate it for spread it out for the number of months, then each month you're gonna pay exactly the same. And that is how we calculate the mortgage payment for 30 years. Okay, so generally a periodic interest rate is a rate that can be changed on the loan or realized on an investment over a specific period of time. Okay, interest per diem fact is the interest charged on the loan on a daily basis most often on the mortgages. In order to calculate the per diem interest amount, lender may use a daily interest rate. So if we want to calculate how much you're going to pay interest rate per day for that particular month, and you want to calculate how much you pay for the whole month, in order to do that, you need to figure out how you're going to pay for that month. Okay, but let's say if your rate is applied for the whole year, right? 5%, 6%, and you take that, you divide by 12, so that is how much interest, the rate that you're going to apply per day, right? And then you apply that on the total remaining balance to find out the actual daily interest rate that you're going to charge and the daily basis amount that you're going to pay. And if you want to multiply by 30, so that is a total. So all this stuff is just like for informative information only, right? Thing that you should know is how to calculate this. Okay, if there's a question like this, trust me, the question on the test is not that hard. Something pretty straightforward. Okay, similar like this: a loan for 1,200, rate of 5. How much is that per year for the interest that gotta pay? $60 per year, right? So if you want to include a $100 payment per month, and you want to pay that, including the interest rate, what's your monthly payment going to be for that whole 12 months? Equally, right? $105, right? You know that the loan is 1,200. And if you want to pay within that year, right? Completely in 1 year, then $60 for the interest. You add that $60 into the loan of 1,200, and you divide by 12, right? And that is a 105 that you're gonna pay per month. Equally for the next 12 months that you're gonna pay off that 1,200 plus 5% rate. Okay, payment interest rate calculation. Again, calculation scenario for mortgage insurance. So let me see here. I think I already did this for some reason I have this slide duplicated. Okay, next one. Payments, calculating down payment amount or percentages. Let's say if you purchase a home, $500,000, the down payment is 20%, then the loan amount is that 500,000 multiplied by that 20%, that meaning that you need to down 100,000. 100,000 is a 20% of a 500,000, right? So when you say you down 20% of $1 million home, that means you need to down $200,000. Okay, loan to value, we already did this. Debt to income ratio. Debt ratio calculation scenario including the DTI equal the monthly housing expenses plus the monthly credit debt divided by the monthly gross income. And that is a DTI. But this DTI is the back-end DTI. Back-end DTI is the DTI that include all the liabilities. Okay, not just the housing expense. So when you look into the number A here, right, the DTI including the monthly housing expenses, which including utility, home insurance, mortgages, property tax, blah blah blah, plus the monthly credit debt and the credit card, your student loan, personal loan, all that add up, and divide by your total income before tax each year. Actually, each month, and if it's a year, you divide by 12 to get each month. So that is how you calculate the DTI. And this DTI, when you have the housing expenses and the credit debt, that is the back end DTI. And if it's only the housing expenses, that is the front end DTI. Okay. Factors in calculating the debt ratio: all monthly housing expenses, every expenses in a month, all loans and credit card monthly payment, every minimum payment that you pay to the credit cards. I said minimum. I didn't say the amount that you pay. You can pay more than minimum, but when we run the credit, we want to determine the DTI. We only calculate the minimum payment. And you remember I mentioned about the American Express. American Express require you pay more. So if you're ready to buy a home, pay up the American Express first. Okay. Gross monthly income. Okay, we already talked about that. So A, permanent note. The promissory note to be executed by the partnership to evidence is an obligation with respect to the permanent loan, which note shall be secured by permanent mortgage. So like I say, the permanent loan or the promissory note is the promise to pay back the loan to the lender. And that's got to be recorded to the county with the deed of trust. Okay, with the grantee. Okay, definition of the discount point. What is a discount point? The point is also known as a discount point by you pay that point to lower the interest rate, right? When you pay a lower interest rate, that is an exchange so that you're paying an upfront fee so that you get the low rate so that you get a lower payment. And that upfront fee may be worth to do so, because like if you have a higher interest rate, then your interest is gonna pay each year or over the 30 years, maybe higher, a couple $100,000 than like a 0.5% or 1% lower interest rate, right? So paying an upfront fee of let's say 10,000, you're probably gonna save yourself like 100,000 or more. Okay, if you're doing that, and only you keep that loan for long. If you think that you're gonna refinance, usually you don't want to pay an upfront fee. And usually you can refinance every 6 months. Okay, that is called a discount point. Discount point calculation scenario. Here's an example. When you buy a discount point, they have like several options that you can do, but this is a common option. It's called 2-1 discount point. What does it mean by 2-1? 2-1 meaning that you have two different interest rate applied on this loan when you buy a discount point. Meaning, let's say if your rate is 6%, okay? When you buy a 2-1, right? So meaning that you have two lower interest rate before that you take on the normal interest rate. So if you have the 2-1 and you have a 6% interest, so your first year you're gonna pay 4%. The second year you're gonna pay 5%, and then so that already covered the 2 years. And then the third year and on, you pay the original rate, which is the 6%. And to get the 2-1 down, you may have to pay $3,000 or $5,000. Okay, that's how it works. So an example here is saying, okay, if it's a rate is 4%, your first year rate using the 2% discount point, 2% discount point, meaning that you pay 2% point. Okay, 2% point for a $400,000 rate may be $4,000. Okay, so you pay $4,000 upfront to get the discount point, right? And what you pay is that if it's a 2-1, then 4% subtract the 2 for the first year. So the first year you pay 2%, right? If the rate is actually 4%, then the first year you pay 2%. Okay. The second year you're using a 1, right? Which is the one after. Okay. Then the discount point is a 4%. Subtract a 1, then now you pay 3% for the second year. That is how it's calculated. The discount point applied to the rate for the first 2 years. Okay. Hopefully that's simple. Purpose of a discount point is to lower the interest rate for the first 2 years to accommodate the borrower payments when the interest rate is high. Knowingly the rate might go down after 2 years. So it's just a strategy, right? If after 2 years you don't see the rate going down, maybe you can refinance. Or if it's going down lower, you can also refinance. Okay, payments, closing costs, and prepay items. Closing costs, prepay item calculation, including using the debit or the credit column to calculate the final total cost. So there is an accounting method, right? It's called a debit and a credit column. Okay, so let's say if you have these items, item A, B, C, D. Okay, and if item A in the closing disclosure say it's a debit, then this is the amount that you're gonna pay. Okay, if it's item B say it's a credit, then the credit gonna be marked on this side, right? So when that happens, is that any debit that is something you pay at the closing cost, you bring in money to pay for that. The credit is that something that's gonna subtract from your total, right? It's just the money that you don't have to pay, and you can subtract from your total, right? That's something that either the lender give it to you, either the seller give it to you, right? So we're using the accounting for a method by debit and credit column. Okay, ARMS, fully indexed rate, interest rate adjustment calculation scenario. Okay, so this is interesting here that we're gonna use an example to calculate the ARM, right? We talk about the ARM, but we don't know how we're gonna calculate the ARM. Okay, so with a 5-1 ARM, that would be a 5 years, right? Interest only, or you can pay principal if you want to. When we say a 5 years, it's a 60 payment. Okay, 5 years, 12 months, 60 payment. So the second digit 1 is how often the ARM will adjust after the fixed period of time at the 61st payment with a 5-1 ARM. So if you see the 5-1 ARM, that means 5 years fixed rate. After that 5 years, right? Every year indicate by the 1. Every year the rate gonna adjust. Okay, so meaning if it's a 5-2, then every 2 years, or 7-1, 7 years fixed. Every year after that, every 1 year after that, gonna be adjust, based on the market rate. Okay, so your rate will continue to adjust once a year on the anniversary of the first adjustment date. Okay, that date can be varies, right? If you take a loan on the December 15, then next year on the December 14 it's gonna adjust, right? And then December 15 you're gonna pay the new rate. Okay, so you may also see a 5-6 ARM. What does that mean? That means the payment will adjust every 6 months, not every 6 years. Okay, in this case it's every 6 months, right? You see a 5-1 is a 5-year fixed and adjust every 1 year. Adjusting meaning that every year after the first 5 years, right, the rate will adjust. It can go up, it can go down for the whole year. Okay, and then the year after that, it's gonna adjust it again. Okay, but when you see a 5-6, that's the 6 stand for the months. It's not the 6 stand for the years. Okay, so you don't adjust like every 6 years. Okay, it doesn't happen that way. Okay, cap. The caps are in place to restrict how high or low your ARM can adjust. So, and just like ARM, they can vary too. So the common caps are 525 or 226 for the 5-1 arm. So for the 5 years one arm adjustment rate, right? You may have the cap of 525 or 226. Okay, what does that mean, right? What does it mean by 525? What does it mean by 226? Okay, let's explain it. The first digit for the cap of 226 is the first digit is how much the interest rate can adjust at the first adjustment point. So if you have a 5-1 arm with a 226 cap, okay, so this go in hand, right? 5-1, 226. Your rate may adjust up or down no more than 2%, which represent the first number 2. Okay, the first number 2, that your rate adjustment cannot be greater than 2%. Okay, at the first adjustment date. Okay, so first year adjustment. So for example, if you have a cap of 525, the rate adjust cannot be go any higher than 5%, up or down. Okay, so the second digit, what does that mean? Okay, is how much the rate adjusts up or down after the first adjustment, every adjustment point thereafter. So once a year, if you have a 5-1 arm, every 6 months, if you have a 5-6 arm, let me see here. What did I wrote here? The second digit of the cap is how much the rate may adjust up or down after the first adjustment for every adjustment point thereafter. Okay, so meaning that so this is a little bit unclear for the number 2 here. The second digit of the cap is how much the rate may adjust up or down. So meaning the maximum that the rate can go is up 2% or down 2%. Okay, so let's say this year your rate is 4%, right? The next year, the cap say that your rate cannot go any higher than 6% or cannot go any lower than 2%. So you take 4%, you plus 2, that's your max, 6%. So meaning your rate, whatever the calculation adjustment is, it cannot go up than 6%. Or the bottom range, it cannot 4% subtract by 2, you can the rate cannot go any lower than 2%. Okay, that's what number 2 mean. And the 6 here is a month, right? It's that just every 6 months. Okay, the last digit is the most common rate. Let me see here. Okay, I'm sorry. That 6 is 45 years, 5-6. Okay, the last digit of the cap, which is the 6, is the most common rate could ever adjust to. Also to be referred to as the ceiling. So the last number meaning that if it's adjustment, the interest rate of the market it cannot go higher than 6%. If your current rate is 4%, then your max is going to be always 6%. It cannot go any higher than that. Okay, so that last 6 is the maximum rate that can be. Okay, so this determines the adding the last digit to the original note rate. Okay. Okay, I'm sorry. A mistake on the last one. That last one meaning that it's number 6, and if your original rate is 4, the maximum is 10. I'm sorry, it's not 6. Okay, so you take that 6, you plus the 4. So maximum number that the adjustment can go is 10%. It cannot go to 11, 12, 15, 20%. Because sometimes the rate can go all the way to 20, 22%. Okay? And okay, when your fixed period is over, your rate will adjust based on what your mortgage balance is at the adjustment. 60 months, for this example, the formula for this is preset by the margin to the index. The index may be based on several options. The margin may vary as well, such as between 2.25% to 2.875% for the prime mortgages. Subprime mortgages and the ARM option may have larger margin. So this is just like it say that this is just a margin on how the bank charge. Okay, so the rate is the prime rate plus the margin, and the margin can fluctuate between 2.25% to 0.875%. Okay, so here is some additional payments, right? For the program of ARM 5.1, the rate is 4.5 and the cap is 2.26. So you know that the maximum rate that this loan can be is 10.5%. I'll take 4.5 I plus 6, okay? And you know that the cap adjustment can only maximum at 6.5% for every adjustment, okay? Let's say if the index 1 is 4%, the index 2 is 5%, and the margin is 2.5%. How are we going to calculate this? Okay, so let's say this is a 5.1. So the first 5 year, the rate going to be fixed at 4.5% rate. Okay, year number 6, you get the fully indexed rate, which is you get the rate 4.5. Okay, you plus the margin, or actually you take the index rate, which is a 4%. You plus the margin, which is the 2.5% here. So you get the fully indexed rate of 6.5% for year number 6. For year number 6, okay? Hopefully you understand this. Okay, now we try to calculate the adjustment after the year number 5. So we calculate the rate for year number 6. And to do so, we have these information available to us. And we have the fully indexed rate by get the index 1, 4%, plus the margin, 2.5%. So the 6.5% is the rate that's going to be applied to the 6 year. However, that rate needs to match with the caps. Okay, so now let's test the cap and see if that rate matches the cap. So if the rate is 6.5%, subtract by original rate, the first 5 year rate, 4.5, that equals 2%. 2% is meeting with the number 2 here, the first number 2 here. So it's okay with the cap. So meaning that with the margin, with the index, it's still at 4%, 6.5% is good. But what happened if the index is 5%, 7%, then you're going to max out at 6.5%. You cannot go any higher than that. Okay, so let's say, if we're looking at this example, we see that the new rate is 6.5% because the cap say, okay, it's within the 2% cap here. So that new rate of 6.5% is good. So even though it doesn't satisfy with the last number 6, right? The rate number 6, the rate, the ceiling, it's greater than the 6% ceiling. So the new rate going to be fixed at 6%. Okay, so that is how we calculate the cap and the adjustable rate mortgage as well as the caps using the index and the margin. Okay, this is a little bit confusing, right? It's probably going to need you to go back, plug in some number, try this math out, and familiar with yourself how to calculate it, so that if this is a question in the test, you can quickly, it's probably going to ask you what is the fully indexed rate. And then you take index 1 plus the margin, 6.5%, right? 4 plus 2.5, 6.5%. And it's going to ask you, okay, if I have an ARM 5.1, 4.5, 2.26, is the cap, it's okay for the first adjustment, right? And then you just have to calculate it and say, okay, 2% for the first adjustment, right? It meets that, so the cap is okay. So this rate stands. Okay, so this is how you're gonna calculate the cap and the ARM. Okay, so the formula on the right side here, you're gonna see a qualified mortgage monthly payment calculation. This formula is used to calculate how much a borrower is paid monthly, and the notation here is the M for monthly payment, P stands for principal, I for interest rate, and N for number of months. So let's say if you have because this is calculate how much you pay a month. Believe it or not, the M going to be always equal for 30, for the total number of N months. Okay, if it's a 360 months, then the M going to be always the same, even though the P and I may change. Okay, so this is just a calculation. If you plug this into an Excel spreadsheet, you may see, and give it some number, you may see, some equal monthly payment. Okay, guess what? We're done with that. Awesome. Any question? I would suggest the math I'm explaining here maybe a little bit lengthy, maybe a little bit unclear, but you'll go back and take a look at this slide here as well as this slide and try to see if you can make sense yourself on how to calculate the payment for the arm. Because trust me, this may be on the test too, okay? So just familiar yourself with this. Try to remember, okay, if it's a ARM 5.1 program with that rate, with the caps, right? Try to memorize what the caps are, right? 226. The first two is how much the interest rate can adjust for the first adjustment. It cannot go higher than 2%. The second digit two is how much the rate adjusts up or down after the first adjustment. So meaning the second adjustment and so on. Okay. And the sixth at the end is the most the rate can go up. Get that six, plus the. It's kind of also interesting because like if we with the new rate, right? The new rate say that with the ceiling is 6, it cannot go any higher than 6, meaning that the new rate need to be stay at 6%. Right? This is the example it's saying. So like I say, look at these two slides and then make sense of it. You have to calculate this. And guess what? In the test, they may give you a notepad, erasable notepad. Okay, that you can just erase it after you're done, and a calculator. So make sure you know how to calculate the arm with the caps. Okay, look at this two slide. Okay, anybody have any question? Anything? Okay, if nothing, then I'll see you. Trung, Quang, anybody have any question? Trung?
No, no, good. Thank you.
Yeah. So
No
you get ready to go and take a test. Make sure you know how to do some of those calculations. Okay. Look at it, and then right away how you're going to calculate it. Because sometimes it's confusing too with that those three caps number. Just understand what each cap number is, right, and apply accordingly to the math. Play around it, do like several times, practice like 5 or 10 times. Give it a different numbers, right? Just because like all this is just fundamental for your understanding. Because eventually that you probably not even touched it. But if you need to go back and know how to calculate this, you can Google it, or you can go on the NMLS website and try to locate for the information. Okay. So if there's nothing, I wish everybody a happy weekend, and I'll see you on Monday. Okay.
Yep. Thank you, Juan.
Good night.
Happy weekend, man. Thank you.
Okay. Happy weekend.